Good morning, my dear future chartered accountants. I hope everybody is doing great. First of all, can you please confirm that my voice is clear and the PPT also is visible? Yes, thank you. So, we discussed in the previous session the basics. Financial management, the main objective is to make a decision where we follow cost benefit analysis. Cost, you can say the price, what we pay. Benefit is the value we get. And the value we mean present value in our subject, and present value we can obtain by either discounting factor or annuity factor. Discounting factor is applicable for a particular year. Annuity factor is applicable for certain number of years, where every year cash flow is same. Then we discussed the overall concepts of uh, compounding, discounting, compounding more than once a year, half yearly, quarterly, continuously, and also the concept of IRR and the concept of average. Now we are going for a new chapter. As per Institute study material, the chapter name is Security Valuation. So what problem Institute has done, I'll just explain quickly. So you should aware the chapter allocation, what I am following, what institute is there in the study material. So what ICAI has done, they have security valuation where they have considered equity as well as debt, and then they come to corporate valuation towards the end. Chapter 13 is there, chapter 12, and there they're having about equity again. So they're having equity in two places. Sometimes the formulas repeat also. So what I have done, the security valuation, I have excluded, or I'll just do one thing. This should make it more clear. Security valuation, they had debt as well as equity. So what I have done, this security valuation plus debt. In security valuation, I am calling it as bond valuation. And this corporate equity and equity valuation, whether it's part of security or corporate valuation, together I'm calling it as corporate valuation. That is basically about equity. Hope you understood the thing what I'm doing. In this chapter, we will discuss only about bond, fixed income securities. And when we go to the corporate valuation, we will discuss only about equity. So broadly, you are having two investment choices from the investor point of view: bond and equity and debt. That is what we are discussing in two separate chapters. So first, let's come to the bond valuation. So what I'm trying to do, I'll try to do this for other chapter as well. Initially, I'll try to spend as much as time as possible to give you the overview, comprehensive overview. So I am sure this might be a little boring for some people because I will be discussing too many theory points, too many concepts. There is one method. I tell the concept, we will do a problem. There is one method. I would like to give overview first, overall discussion of bond valuation. Then we can take a problem based on that. Of course, when I'm explaining also, I'll be taking numericals to make you understand the concept. So bear with me. First, let's go through the concepts in detail and then we'll take up the problems. There again, I'll explain the concept so that it will be a kind of revision as well as you will be able to do the problems. But I understand you're in the morning session struggling yourself to sit in some place, putting all the efforts to listen to my voice. It's hard, it's not easy, but put your best efforts. Okay, so let's come to the bond. So we are having two sets of people here. One, let's say, investor, and the other one is, let's say, company, or let's say issuer. Company, investor, issuer. Now the instrument what we are having is bond. So investor gives the money, issue to the issuer. That's what is bond initially. So investor invest or issuer raise the money. Bonds. So they make the amount, issuer raise the money, issuer raise the money by issuing the bonds. And what the investor gets is regular payments. What he will get back regular payments, that is called as coupon. Basically like interest what you say, but I don't use the word interest. Why? I'll tell you later. So coupon is paid regularly, periodically, yearly, half yearly, and one time full amount is paid, that is redemption price. Redemption price, that is on maturity. Now please tell me, is this very similar to the company taking loan from the bank? Company takes loan from the bank and they pay interest and they repay the money on maturity. This coupon is fixed. It is a percentage applicable on face value, and this is like a loan, this is like a debt, or this will have some sort of security also. We have secured bond as well as unsecured bond. Now please tell me, what do you think? Is this very similar to loan, or if not, how it is different from loan? Company taking a loan from a bank. They raise money. What do you think? Is it same as taking a loan? If not, how it is different? Okay, I believe you're not getting the answer. So I'll tell it myself. It is similar to loan in many aspects, in terms of obtaining loan, in terms of repayment, in terms of interest, so on. So it is having many features of a loan. So I will say features of bond, features of bond or debenture. It has it is similar to loan, or we say it is a debt representing security. It represents debt of a company. It is similar to loan in many aspects. It is similar to loan in many aspects, such as the whatever it's a loan. I mean it's a debt, such as it is debt for a company. There will be lender, and there will be interest payment regularly, interest payment, and repayments, etc. It is very similar in all these aspects, but it is different from loan in one important feature. It is different from loan. One important feature, Can you tell me what it is? The loan don't have that feature, whereas a bond has that feature. It is different from the loan, that is in marketability or security, in marketability. What do you mean by marketability? This bond can be transferred, can be sold. There is a market for it. Whereas in case of loan, there is no market. Loan cannot be sold. So this investor can sell this bond to another person. This investor can sell or sell to another investor or another bondholder, another investor. So it's a transferable instrument. That is the main point. So bond is a transferable instrument. Transferable instrument. Okay, so please write down these basics of bond valuation, one basic chart and the features of bond. And if you have done, let me know it. Then I'll go for some numerical examples. Is it completed? Have you taken it down? Yes? Okay, fine. Okay, fine. Next. So what is the main important aspect here in respect bond valuation is the marketability. So we have to understand the market price. How do you value it? So first topic for us is valuation of bonds. Valuation of bonds. Okay, now first of all, let me give one basic simple concept. Now please tell me, if new person want to become an investor in the bond, see, company issue the bond, initial investor, he becomes the bond holder. But sometime later, if I want to invest in bond, is it possible or not? What do you think? Company has issued to some investor, that is bondholder, but now I want to be the bondholder of that company. So how do I do that? How I can become a bondholder of an existing company who has issued the bonds, let's say 2 years back? Can I become the bondholder of that company, or should I wait for that company to issue next time? Okay, I think the flow is not coming, so I'm not getting the any feedbacks for any of my questions. So, okay, so I think you don't want much of interactive sessions. Then I'll make it one way only. I can't help. Fine. So let me first mute all. Fine. So as I just showed you, now company is there, issuer is there, company issue the bond, a person becomes the bond investor. But later if somebody wants to become the holder, then he has to purchase from the market. Keeping that in mind, if let's say issue price or let's say face value only is 1000 and coupon payment is let's say 8%, and let's say maturity period is 5 years. Okay, now every year how much you get? Coupon 8% per annum. So 8% on 1000, you will get 80 rupees every year. So many people think that this coupon is your income. Many people think that. Oh, I've invested 1000, I get 8% per annum. So 80 rupees my income. That is my income. 80 rupees every year I get. But the answer is not true. Why? Because later point in time, suppose market price has become 1100, just for example purpose, then I still get 80 rupees only. 8% will be on face value. Coupon will be not on market price. So if I think from investor point of view, what is my return? My return is not 8%, right? Because 80 rupees on 1100, if you calculate, then it will come to so 80 80 by 1100 into 100, you get almost only 7.27 percentage. If you think from investor point of view, his return. And therefore, you cannot say that coupon is the income for the investor, or you have to come out from that mindset that the regular income what I'm getting, that is not the true income from the investor point of view. Income is different from cash flow. In other words, the coupon what you take it, you treat like a cash flow and not an income. So in valuation of bonds, you have to understand the coupon what is paid out regularly is to be treated like a cash flow and not like a income. So there is a difference between income and cash flow. For example, there is something called a zero coupon bonds. What is zero coupon bond? You invest at 1000 rupees and you don't get any coupon, and you may get maturity of 1100 after 5 years, let's say. So every year you don't get any income. Does it mean this is not providing any income? No. One time you are getting 100 rupees, and if spread across 5 years, 100 by 5, you get 20 rupees per annum. I'm just telling you as a concept, right? So you have to come out from that mindset. Coupon is treated like a cash flow and don't treat like a income, and that is why we are using the word coupon and not using the word interest. And this what we're discussing now is also going to play a very important role in your FR paper, especially in financial instruments. Anyway, let's come back to this. So valuation of bond is ultimately value of bond. Value of bond is present value of future cash flows. Present value of future cash flows. So what are the future cash flows? Regular cash flows are, year 1, year 2, year 3, dot, 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 dot. Every year what you get is coupon, which will be fixed amount. So coupon for year 1, coupon for year 2, coupon for year 3, and so on. Last year, I will say year end, you will get coupon also, and last year you get redemption price. And this present value, when you calculate the coupon, I told you coupon you treat like a cash flow, the regular cash flow, and every coupon you do a present value, and last year coupon as well as redemption price, the present value what you get, and that is what is value of the bond. That is how much you should be ready to pay, equals value of the bond. And since every year coupon is same, for coupon discounting I can use annuity factor, and for redemption price discounting I can use discounting factor. I can do faster. Otherwise coupon also I can do it one by one. So please write down this. After this I'm going to write it in a formula format, equation format, and then we'll write in our regular tabulation format. So first write the chart format, representation of present value calculation. And of course, present value you have to discount by required rate of return. And remember, coupon is a percentage calculated on face value only, not on market price. In some charts, I'm getting the answer that 8% should not be applied on 1100. This is always applied on face value, not on market price. Coupon does not change. Coupon remains fixed. It is fixed. This is fixed coupon. We have certain varieties also, which we'll understand as we go further. Okay, I'll go further on this. So if you write it in a formula format or equation format, present value of the bonds, equation format, value of bond is given by the coupon divided by, I'll say 1 plus K, discounting rate, first year discounting rate, plus second year discounted coupon divided by 1 plus K whole square. I hope you understand what we are doing. I'm calculating present value. What is the present value formula? Future value by 1 plus R to the power of N. So first year cash flow, I'm computing present value. Second year coupon, I'm computing present value, and so on. And last year redemption value divided by 1 plus K to the power of N. Last year, nth year. Since coupon is same every year, I can write like this: coupon multiplied by annuity factor, because every year coupon will be same, and redemption price, redemption value, RV, redemption value multiplied by discounting factor. If I write in tabulation format, value of the bonds is, or if I write in tabulation format like year, cash flow, discounting factor, discounted value. Year 1 to nth year, every cash flow I get coupon, multiplied by discounting factor, I'll multiply it by annuity factor. Every year coupon will be same, but sometimes coupon will be different also. In that case, I have to use every year discounting factor separately. And last year, I'll get redemption value, and we multiply it by the last year discounting factor. Whatever the amount I get, that present value total is the value of bonds. So write down this equation format for valuation of bond, tabulation format of valuation of bond. This value, people also call it as intrinsic value. Okay, hope you've taken down. I'll go further. Now, the two things you have to understand, one important point, that is required rates versus coupon rate. Why these two differs? Required rate of return versus coupon rate. Now, one thing will be there. Practically, who will fix the coupon rates? Do you think company will fix the coupon rate, or uh, market will fix the coupon rate, or investor will fix the coupon rate? Who decides the coupon rate? The coupon rate is actually decided by market factors, or it will have impact market factors. Just like FD interest rate. Who will decide FD interest rate, sir? Bank will decide. Bank will decide FD interest rate. But how does bank will decide? Now, for example, SBI is there, HDFC Bank is there. Okay, and now in the SBI tells FD rate of, let's say, 1%. Now, if SBI says 1% FD rates, will you keep the money in SBI? No, right? You go to HDFC Bank, you go to Axis Bank, you go to Canara Bank, because they are equivalent banks having similar characteristics. You'll invest the FD there. Therefore, it is decided by market factors. Of course, RBI also is going to play a role. RBI will fix a benchmark. We have repo rate, reverse repo rate, many things to learn. But one thing you keep it in mind: coupon rate, it is fixed by company as per the agreement, but it is influenced by market factors. So, as we just understood, you will have the investor and you will have the issuer, right? And investor invest money, and issuer will make the payment of coupon. And how this coupon will be decided, that is the market rate at the time of issue, the rate prevailing in market at the time of issue. Rate prevailing in the market at the time of issue. That means if I take the fixed deposit now for 5 years, I'll get today interest, whatever is running in the market. What is today FD interest? FD interest is around 5% now, 5.5%, 5% now. But had I taken the fixed deposit 10 years back, at that point in time, what would be the FD rate of interest? It might be even as high as 8%, 9%. I hope you're getting the point. The rate of interest is influenced by the prevailing market factors. So, companies issuing the bonds today in the year 2025, let's say, in the year 2025, whatever is the market rate, and that will be given. So, when or we can write like this: at the time of issue, or at the time of issue, at the time of issue, the coupon rate will be equal to required rate of investor. And how investor decides what he requires, that's based on market rate at that time. Market rate at that time. I hope you got this point. I'll be spending a little bit more time. Don't think it is I'm dragging this, because practically many people think about stock market. But the stock market is important on one important feature called as liquidity, and the liquidity is decided by the bond markets, the fixed income market. The more you understand this, the liquidity aspect, how the money comes in and goes out, and this can influence stock market. You can play, you can trade, you can invest in stock market better if you understand the cycles in fixed income market. Anyway, keep that aside. I'm only trying to tell one simple point. The required rate is from the investor point of view. Coupon rate is what is provided by the company. And that will be equal at the time of issue. Because how does company decide? How does the banker decide what should be the FD rate? Depends on market rate at that point in time. So what will be the coupon rate the company is going to pay is what is required rate of return for the investor, and what is required rate of return for the investor, that is market rate at that time. Market rate at that time. Now later, as the time progress, as the time progress, required rate of return will change. Why? Market factors will change. 10 years back, the position of the economy was different. Now the position of economy is different. 10 years back, had you put FD, it would have gone for 8-9%. Now the FD is coming only for 5-6%, 5%. But will the coupon change? What I'm trying to tell, let me explain. Okay, suppose on 1/1/2020, company issues bond, face value 1000, coupon rate let's say 8%, and number of years, let's say 10 years. That means what? 2030 or 31st December 2019, 10 years is the maturity. And coupon rate 8%. What do you mean by coupon rate 8%? As on 1/1/2020, the market people are expecting 8% from the company. Initially, what do you expect is what I give. So on 1/1/2020, the required rate also will be 8%, because that's how they will fix the coupon rate. Whatever is the expectation of the market, that's what I should pay. If I don't pay, people will not subscribe to me, people will not invest me. I told you an example of SBI. If SBI don't pay the market rate, then we'll go somewhere else. Okay, this is on 1/1/2020. Now let's say 3 years over, 3 years over, that is on 1/1/2023. What will happen to the coupon rate? Coupon rates. Do you think it will remain as 8% or it will change? Coupon rate is like FD rate. If you are investing or this instrument is valid for 10 years, once the coupon is fixed till maturity, it does not change. We are having that method also, that's called as the floating coupon. We'll discuss it later. But the coupon rate 8% remains fixed. Remains fixed. That does not change. But what will happen to the required rate? Will it remain same or not? It will not remain same, because the new investor, he will compare what alternative I have. This instrument might have been issued 10 years back, but as a new investor, I am looking at the alternatives. If I invest in this bond, how much I get? If I invest in this bond, how much I get? I mean, it has to fulfill my expectation. The required rate would have changed. It will not remain same. It would have changed. It would have changed. And when the required rate changes, because of which you cannot change the coupon, you cannot change the redemption price, because they are fixed. Value of the bond is coupon and redemption price. Value of the bond you cannot change. Coupon redemption price you cannot change. I mean, coupon you cannot change. Redemption price you cannot change. Only what you can change is market price. In the sense, the value of the bond is what changes. And why required rate of return changes? It may be because of economy, or it might be because of GST happened, demonetization happened, Corona happened, for which RBI has to change the base interest rates. So interest rate level in the economy will change. So required rate changed because market factor change would have changed because of market factors, economy level, inflation situation, RBI policy, various things, market factors. I'll simply put it as market factors would have changed. So this is how. So how do you calculate the value of the bonds? Let me calculate. You can note down this example. I'll quickly compute the value of the bonds on 1/1/2020. How the value of the bond is there. 3 years later, how the bond will change. Okay. I'll taking the same example. I'll go further. On 1/1/2020, what is the value of the bond? How do we calculate value of bond? I'll use the simple tabular format. Year, cash flow, discounting factor, discounted cash flow. Year 1 to 10 years. 10 years is there. And instead of calculating every year one by one, I will do annuity factor method, because every year cash flow will be same. Coupon 8% on face value 1000, that is 80 rupees. And discounting factor is how much? Discounting factor is 8% only, because coupon rate and discounting rate, the required rate of return, both are same at the time of issue. So what will be the present value? How do you calculate? 1 divided by 1.08 press equal to 10 times, and then press GT, or you can press equal to M plus every time. 6.7101. I'll take 4 decimal usually. 6.7101. 80 into 6.7101, 536.81. And last year, you get the redemption value. When nothing is given, the face value itself is redemption value, which is 1000 rupees. Face value itself redemption value when nothing is specified. It is redeemable at par. When nothing is given, redeemable at par. And last year, don't take annuity factor. Last year, only one cash flow. So discounting factor last year. 0.4632. Yeah, 0.4632. So multiply, you get 463.2. 536.8 plus 463.2, you get thousands. So value of the bond is 1000. Okay, this is at the time of issue. Now on 1/1/2023, in the sense 3 years later, value of the bonds. Suppose at that point in time, required rate of return has become, let's say, 6%. You see, you understand what is happening now? Because of various market factors, corona, GST, demonetization, RBI policy, rate of interest has fallen. So required rate of people is also now less, only 6%. So what will be the value of the bond then? Year, cash flow, discounting factor, at what rate? What is the required rate? Now the required rate is 6%. So discounting factor is at 6%. And let's calculate discounted cash flow. And year 1 to how many years? Can you tell me? Previously we have taken year 1 to 10. And here how many years I have to take? Okay. In financial management, I told you it's always about decision making. It's always about future. So you should look at how many remaining cash flows are there. What was the original life? Original life was 10 years. Out of 10 years, 3 years over. Don't look at what happened in the past. Look at what is going to happen in the future. In the sense, it is remaining years to maturity. So we should select 7 years. 3 years over, remaining maturity. Remaining years, 7 years. Cash flow will be remaining same, okay? This 80 will be fixed. That will not change. So discounting factor at 6%. Recalculate. Discounting factor at 6% for a period of 7 years. So 1 by 1.06 equals 3, 4, 5, 6, 7. I think you get 5.5824. Of course, you press GT at the end. And last year, 7th year, you get redemption value only, thousands. And that redemption value will be 1 by 1.06 equal to 7 times, no GT, 0.6651. So 80 into 5.5824, 446.59. 1000 into 0.6651, 665.1. So total 111.69 value of the bond. So 1000 has become 1111.69. Okay. If it is, let's say, on the same date, 1/1/2023, suppose required rate is not 6%, suppose it has become 10%. That is rate of return not increased but decreased but not increased. 8% was the original rate, then 6% reduces. That is what we have done. Why don't you do another situation? What if it increases? 8% becomes 10%. In that situation, what would you analyze? In the sense, what would be the value of the bond? Let's recalculate quickly. Year cash flow, discounting factor at the rate of 10%, discounted cash flow. Year 1 to 7, year 7, cash flow 80,000, and discounting factor 10%, 1 by 1.1 plus equals to 7 times GT. 4.8684, I think. 4.8684. And last discounting factor 0.5132. So this is 513.2, 389.47. So total 389.47 plus 513.2, 902.67. This is value of the bond. So ultimate concept of value of the bond, any valuation in financial management is present value of future cash flows. And here the future cash flows are coupon and redemption price. And when you discount using your required rate, expected rate, that's how you get value of the bond. Okay, hope you understood now. One thing you please observe, when 8% became 6%, when the discounting rate reduced, what happened to the market price? 1000 became 1011.69. When the discount rate reduced, market price increased. And when 8% became 10%, when the discounting rate increased, what happened to the market price? The 1000 became 9 902 market price reduced. Remember, I told you inverse relationship. The market price, when the discounting rate reduces, the present value increase. When the discounting rate increase, the present value reduce. And more importantly, you can understand this in one more manner. If your coupon rate and required rate both are equal, then present value will be equal to face value. If your required rate is less, then the present value will be more. If required rate is more, the present value will be less. Let's try to do these observations. First of all, the value of the bond and required rate. Inversely related, correct? Inversely related. Inversely related. I'm not writing in sentences. Hope you understand. Inversely related. One increase, other decrease. Then, if required rates is equal to coupon rate, then it implies your value of the bond will be equal to face value, because redeemable at par, that's why. Otherwise, that's redeemable value is equal to face value. If required rates is more than coupon rate, if required rate is more than coupon rate, then value of the bond will be lesser than face value. Value of the bond will be less than face value. Okay, now let me tell you the logic behind this. Then I'll write other situation. When required rate is more, why value of the bond will be less? It happened in last situation, right? It became 10%. Okay, now back to basics. Keep it simple. Think from investor point of view. What is my cash inflow and what is my cash outflow? Investor point of view, my cash inflow is coupon and my cash inflow is redemption price. Yes, coupon, redemption price, which is fixed, cannot change. And my cash outflow is value of the bond, the price at which I'm going to purchase. You can say market price. The value of the bond, market price, I'm going to pay. Are you understanding? Two cash inflow. Coupon is my cash inflow. Redemption price is my inflow. My outflow is market price. The investment value. That is my outflow. Now, let's say coupon rate is, in this case, 8%. And my required rate of return is 10%. I need 2% extra. 8%, which I want, I will get in coupon, which is I'm getting 8%, but I want 10% and I want 2% extra. And where I'm going for the 2% extra, I cannot change coupon, fixed. I cannot change redemption value, fixed, but I want the 2% extra. Where will I go? When I'm making a payment, I make less payment. Are you getting my point? Or can I tell you like this? If you think from investor point of view, there are two types of profit, or in income tax angle, there are two kinds of heads of income. For the bondholder, I have one coupon, which is my income from other source, and I have one more. What is that? Income from capital gains. The difference between my investment price and my redemption price, my buy price, my sale price. My buy price is the investment price, sale price is the redemption price. I have coupon as one profit, right? Coupon as one income. Another income is my capital gain, redeemable value minus market price, the value of the bond. Now, coupon, I cannot change it. Now, only way for me to achieve the 2% extra, I want extra income. How do I make that extra income? By paying less, by getting more capital gain. I'll repeat once more. In this example, you require 10% rate of return, but the company is providing only 8%. 8% you are getting in the form of coupon, but you need extra 2% which you will achieve by capital gains, by paying less. That is what is market price. So why value of bond is less than face value? Because you can write down the excess return. The excess return. What is excess return? Required rate minus coupon rate. The excess return is achieved by paying less. Reducing your cost, basically. I want more profit, reduce my cost. So excess return is achieved by paying less. Excess return is achieved by paying less. By paying less. Okay, another case. Required rate is less than coupon rates. Reverse, opposite. In that case, what happens? Value of the bond is more than face value. Value of the bond is more than face value. And why? Because they are offering 8%, but you want only 6%. You don't want that extra 2. That extra 2, what you don't want, will increase your cost. So opposite of the previous one. So you understand one, that is sufficient. So when required rate of return is less than coupon rate, value of the bond will be more than face value. Or in other words, the excess return which you don't want, it will be taken away, or you are end up in paying extra price. And thereby you achieve your required rate. Okay. One more thing you observe. One more thing you observe. 8% 8% became 6%. 2% change. And for 2% change, 1000 became 1111. So 111 rupees increase. 111. But 8% became 10%. 2% change. But 1000 rupee becoming 902, not 111. It's some 998. You understand, right? 2% upside and 2% downside, the moments are not equal. We say the relationship is not linear, it is curvilinear. Just keep it in mind. I'll discuss little bit later, but just observation, just keep it in mind. 2% upside, the change is not equal to 2% downside. Now, 8% became 6%, 2% downside. What is the change in the value? 1000 became 1011, 111. 8% became 10%, 2% increased, but the value 1000 became 902, that is 998. So 2% upside change is not equal to 2% downside change. We say the relationship is inverse but not linear. It is not equal. It is curvilinear. Anyway, we'll discuss little later. Okay. Now, next question is what factors influence required rate? What factors influence required rate, or why required rate changes? Why required rate changes? Two important points, or I will say one is called as interest rate risk, other is called as uh, default risk or credit risk. Credit risk or also called as default risk. Okay, what is interest rate risk? That is interest rate in the economy. Interest rate in economy. And what is credit risk? That is credit worthiness of the issuer. Credit worthiness of issuer. Okay, let me spend 1 or 2 minutes on this. Okay. As I told you earlier, if State Bank of India offers only 1%, HDFC Bank offers 5%, Axis Bank offers 5%, Canara Bank offers 5%, obviously you go to other bank, you don't go to SBI. So interest rate movements are what is interest rate in the economy. That's one thing. Second thing, now if some cooperative bank, some NBFCs, Manappuram Finance, Muthoot Finance, they offer even 10%, 12% interest rates versus HDFC Bank or versus SBI. Now, would you go for the cooperative banks because they will give you more rate of interest? Or what is the reason why they're offering more rate of interest? Because they carry more risk. So why people are always favorable to FD in bank? Because it is safe. But whereas you can also put FD in NBFCs, Manappuram Finance, Muthoot, Bajaj Finance. You can also put FD in cooperative banks, some Vishweshwaraya cooperative banks, some cooperative banks, where rate of interest is also high, but risk is also high. That is what is credit worthiness of the issuer. And who will decide the credit worthiness of the issuer in uh, bond market? This concept of identifying credit worthiness of the issuer is called as credit rating. Because when company goes large scale, so many investors will be there. Investors are not experts to understand credit worthiness of the company. So they need to go through agency for rating them. For example, we have most famous agency CRISIL. We have ICRA, ICRA, then CARE, Fitch, Modi. So many ratings are there, Moody ratings. So when the rating is high, AAA, that means it is safest. Rate of interest will be lowest. If double A, little bit less category means more risk, more return. Single A, B, triple B, C, in the sense higher the ratings, lower the risk. In the sense higher risk, higher return. So these are the two main factors which influence required rate. Okay. Now, it's also a perception of risk. Right? This is also a perception of risk. In the sense, one person might feel it is little bit riskier, other person may feel it is little bit more riskier. But ultimately, everything should get reflected in the market price. Okay, I hope you have taken down till here. Now, I'll come to that perception, I'll come to that market price uh, now, little bit later, but hope you have written down till here. Okay, fine. I'll go further. Now, one more question is, will value of the bond be equal to market price always? Will value of the bond is equal to market price? The answer is yes, it will be equal if required rate is equal to the what a market rate, what everybody says, what required rate and what is given by market. That is, if required rate is same as what everybody expects, if required rate is same for all means market participant. No, if required rate is different for investors. I'll say investors. If required rate is same for all investor, then value of the bond is equal to market price. It is not equal when required rate is different for investors. Now, in the examination, if nothing is given, yes, if we assume it is equal, practically what do you think will happen? Everybody will have same required rate, is it? No, everybody's perception will be different. Everybody's situation will be different. Everybody's liquidity position will be different. Somebody requiring more money, somebody requiring some projects happening, somebody requiring surplus money. So, this is more likely to happen practically. Required rate of return is different for investors. So, value of the bond may not be equal to market price. Now, how do we decide whether to invest in the bond? That is very simple. If the value is more than the price, value is what we get, right? Value is more, we will invest in the bond. If value is less, we say don't have to invest in the bond. Okay, now suppose let me take a numerical example. Let's say face value of the bond, or I'll write in the fresh slide. Face value is, let's say, thousands. Coupon, let's keep it simple, let's say 10%. Remaining time to maturity, I don't want how many years it is invested back. Remaining time to maturity. Remaining time to maturity, let's say 5 years. Okay, and I'm giving you market price is, let's say, 950 rupees. Are you getting the point? We are having 5 years. So year 1, year 2, year 3, year 4, year 5. And coupon 10% means what I get? 100 rupees every year, 100 rupee and 1000. Every year I get 100 rupees. And last year I get redemption value 1000. And when I discount this, when I discount this, what is it called as? When you compute the present value of future cash flows, it is called as value of the bond, intrinsic value of the bonds. But when you calculate using the discount rate, required rate of return, that is value of the bond. But I'm not doing value of the bond. What I'm doing? What I'm doing is market price. It should be equal to market price. What is the discounting rate I'm calculating now? Are you getting the point? In the earlier illustrations, what I did, I have gave you the required rate of return. We have computed the present value. Now, I am giving you the present value should be 950. What should be the discounting rates? That is what, remember, what is it called as in our basics chapter? Using the required rate of return, I can calculate the present value. But using the present value, if I calculate the rate of return, then that is called as IRR, right? And here it is called as yield to maturity, YTM. Yield to maturity, YTM. This discounting rates at which you get the present value, that is called as YTM. The discounting rate at which the present value will be equal to market price is called as YTM, yield to maturity. Okay, so let me write the meaning, then I'll go for calculation. YTM, yield to maturity. Yield to maturity. YTM. So basically, this is the yield or return provided by the bonds for the investor if held till maturity. Of course, if you sell in between, market price will be something else. Your actual yield also will be different. But this is the return provided by the bond for the investor if held till maturity. You see, everybody's required rate of return changes, but we are not calculating the value of the bond from investor point of view. This is from instrument point of view. Let me write it. In other words, this is the rate or discounting rate at which present value of coupon and redemption value is equal to market price. What do you mean by that? Let me write it. So you have coupon, you have year 1, year 2, year 3 and last year end. You have coupon, I'll just say C, hope you understand. C for coupon, coupon, redemption value. When I discount it, using required rate of return. If I discount it using required rates, the present value what I get is value of the bond. Differs from person to person, right? Everybody's required rate can change. Whereas if I discount year 1, year 2, year 3, year end, coupon, redemption value, discount it, discounted using YTM. When what will I get it? I get present value as market price. Now, this is same for all, right? Market price, same for all investor. Whereas value of the bond is different, subjective. That's what we discussed basics also. Price is market price, same for everybody, but value of the bond differs from person to person basis. Everybody's required rate of changes, everybody's value of the bond changes, but market price same for everybody. So YTM same for everybody. Other words, value of the bond is from investor point of view, whereas market price and YTM is from instrument point of view, IRR. Value of the bond is investor point of view, whereas market price or YTM is instrument point of view. Market price and YTM is from instrument point of view. Okay, so how do we calculate this YTM? There are two methods. One is approximate formula, other is IRR method. That is, one you assume one higher rate, one lower rate, in between that you try to calculate. Interpolation method, that is one more method. Let's calculate that. So basically YTM, I repeat myself, it is from instrument point of view or bond point of view. We have two formulas, methods. One is approximate method, the other one IRR method or interpolation method. Okay, so we'll write this formula. Before that, let's take a break. 7:40 now. Let's take a break of 10 minutes and let's meet at 7:50. Take a break of 10 minutes. Take a break of 10 minutes. Okay, so now we are understanding about YTM, yield to maturity. Basically, we are finding the discounting rate from the instrument point of view based on market price. So we have two formulas. Approximate method is easy, IRR method more accurate. But in the examination, if they just ask you YTM, you can use any of the methods. So approximation method means the formula is numerator is like a return, denominator is like an investment. Numerator is coupon, there is a return, and then redemption value minus market price. RB, redemption value minus market price divided by N, remaining time to maturity, whole divided by average investment, redeemable value plus market price divided by 2. Numerator is like return, denominator is like average investment. IRR method, it is lower percentage plus difference in percentage. You need two different percentages, one higher percentage, one lower percentage. So difference in percentage divided by difference in present value multiplied by, I need a little more space, hope I can write it, the present value at lower percentage minus market price investment. The IRR method, what we have learned in the basics. And decision, if IRR is more than required rate of return, that bond is recommended to be invested. Okay, now let me quickly apply for this problem. This illustration I given 1010%. Okay, now think logically for this illustration. What is my regular income? My regular income every year is 100 rupees, and additionally I'm investing 950. I'm getting thousands. So what is my extra return? Extra return is 50 rupees. Capital gain, investment 950, redemption 1000. Buy price 950, the sale value 1000. But that will not come every year. That will come only once. So if I have to calculate YTM for this problem using approximation method, what is the coupon? The coupon I get every year 100 rupees, 1000 into 10%. Then redemption value 1000 rupees minus market price 950 rupees. Capital gain 50 rupees. But this 50 rupees I get only once. So I'll spread across remaining life divided by 5. Like a depreciation, I amortize. My income also I distribute. Divided by average investment. That is thousands plus 900s divided by 2. You can multiply it by 100 to express in percentage. So how much it comes to? So 1000 minus 950 divided by 5, 10 plus 100 divided by 950, 0.1157, or you can multiply it by 100. 11.578, 11.58%. 11.58%. Okay, now let's calculate YTM using interpolation method. Okay, for interpolation, I need two percentages. Now, 1% I already know it. What is that? Please tell me, if my coupon rate is 10% and my discounting rate is also 10%, what will happen to the present value? I hope you know it. When my discounting rate and coupon rate both are equal, my required rate of return, coupon rate, both are equal, I can calculate. But you know it. When that happens, that present value will be equal to face value. So that you know it. So if my discounting rate is 10%, then my present value is equal to face value 1000 rupees concept. Or you can assume some other rate. Assume 8%, you can calculate. Now, I want the present value to be market price. What is the market price? That is 950. What is the percentage I require? Now, please tell me, my present value 1000 should become 950. Present value should reduce. Now, present value should reduce means what should happen to the discounting rate? Inversely related. Remember, if the present value should reduce, the rate of interest should increase. Inversely related. So, I should select, let's say, 12%. Assumed a higher rate. So, at 12%, calculate the present value. You know the formats. Present value is calculated by the coupon into annuity factor plus, I can write in an equation format also, plus the redemption value multiplied by discounting factor. I'm not writing in a tabular format. Hope you understand how to calculate this quickly. Coupon, that is 100. Annuity factor, 1 by 12% I'm calculating. 1 by 1.12 press equal to 5 times GT. How much is annuity factor? 10% for 5 years. 3.7908. 1 by 1.1 equal to 5 times GT. 3.7908. Hope you are getting this GT calculation. Plus redemption value, redeemable at par, 1000, into discounting factor. Again, last year discounting factor 10% for 5 years, 0.6209. So this present value, I can do in tabular format. I'm writing it in an equation. Hope you understand. This is 379.08 plus 620.9. Oh, sorry, I should have taken 12%. 12%, what is the discounting rate I get? Not this one, sorry. 12%, I get 3.6048. 3.6048. 1 by 1.12 plus equal to 5 times GT. 3.6048. And this is 0.4019. 12%, sorry, 0.5674. 0.5674. So this is 360.48 plus 567.4, 927.88. It is 927.88. Interpolation method. You can assume one more rate also. You can assume something like 8% and calculate. Between that, you try to do it. Anyway, we got two percentages. We got two present value. Remember, this will happen. That is when discounting rate is that is coupon rate will be present value equal to face value will happen when redeemable at par. If not redeemable at par, you have to recalculate for 10% also. Please calculate it. I repeat, when the coupon rate is equal to the required rate or YTM, present value is equal to the face value. When will it happen? Only when redeemable at par. If not redeemable at par, like the way you calculated this present value for 10% also you recalculate. Here also you can calculate. I know it will come to 1000 only, so we are not doing it. So we got two percentages, we got two values, and let's try to interpolate. So YTM, the IRR method, lower percentage, 10 percentage plus difference in percentage, 12 minus 10, by difference in present value, thousands minus 927.88 into the present value at lower value 1000 minus market price 950. So 10 plus 2 into 50 divided by 1000 minus 927.88, 72.12, 1.38, 1.39. So 11.39. You can see here we got 11.39% and here we got 11.58%. Very close, but IRR or YTM is more accurate. Approximate 11.28 you get, is it? 100 plus 10 divided by 950 into 100. 11.58 only, no? Oh, I took 900. Sorry. I took 900. It should be 950. My mistake. Oh, it should be 950. Okay. So 100 plus 10 divided by 975 into 100. You get 11.28 percentage. Yes, my mistake. Please correct it. 11.28 percentage. 11.28. Here you get 11.39. You can see that there is a difference, but interpolation method is more accurate. But in the exam, if they not asked particular method, you can use any method. So please correct it. I had done one arithmetical error. Please correct it. 11.28. I had taken 900 here. This is 950, and here get 11.39. So we have discussed so far value of the bond, present value of coupon, and present value redemption price, discounting rate, required rate of return. Then YTM, using the present value, using the market price, we are calculating the discounting rate. So when the discounting rate is required rate of return, the present value is value of the bond. When the discounting rate is YTM, the present value is market price. In general, we assume when nothing is specified in the problem, value of the bond equal to market price, YTM equal to required rate of return. When nothing is specified in the problem. But if they have given market price separately, and then we are going to calculate YTM separately. And also keep it in mind, it is YTM, yield till maturity. This is the return obtained by the investor, assuming he invests till the end. And even the intermediate cash flows are assumed to be reinvested. If it is reinvested elsewhere, it's called as realized YTM. There's one more concept. We'll come to it later. But this is the important concept, value of the bond and YTM. These are the two important concepts. I hope it is fine. Okay, next. Two more concepts I will just like to quickly discuss, then I'll go further. That is called as duration, volatility, and convexity. But duration volatility concept is more important. I'll quickly touch upon what is convexity also. First, let me talk about duration. When you invest in a bond having, let's say, 3 years maturity, you invest today, first year you get cash flow, a coupon, second year you get coupon, third year you get coupon also, and you get redemption price. Now, if I ask you, I'm making investment today, when I'm getting it back, in the sense, when the cash flow is returned to you, what is your holding period? Sir, holding period is 3 years. No. First year also you get one portion. Second year also you get one portion. Third year also you get one portion. So you are getting 3 cash flows. You are getting 3 times. So when multiple cash flow exists, how do you convert the multiple values into single number? Statistically, what is it called? When many marks you have, how do we convert into one single mark? We are going to take an average. Similarly, here also we are going to do a average holding period. That's called as duration. So duration is given by average holding period. Duration is given by average holding period. Because you'll having different maturity periods. First year you get coupon, second year you get coupon, last year you get coupon, redemption price, average holding period. Formula wise, we do like this. One column, you will have year. Other column, you will have cash flows. Then discounting factor at the rate of YTM, not required rate, because for everybody the discounting rate changes because of required rate, but we don't want it to change. We want the rate to be same for everybody based on market price, which is YTM. So discounting factor at YTM. Okay, and then I'm going to calculate discounted cash flow, that is cash flow into discounting factor. Okay, now here comes one important point. When I calculate average, I'm not going to calculate a simple average, I'm going to calculate a weighted average. Why weighted average? Because first year amount what I get is not same as second year amount what I get. Because first year coupon I get, second year coupon I get, but the value of first year coupon, the present value, the value of second year coupon changes, and in fact last year redemption price amount itself is changed. So when I do a average, I don't do simple average of the time periods, I'm going to do a weighted average. And in weighted average, we need two columns, one X column and one W column. So what is the X column? What is the W column here? Many people tell me, sir, year is weights column. No, year is not weight column. Year is X column. This year is X column. Why? Because when I calculate average marks, marks is X. If I calculate average speed, the speed is X. If I calculate average salary, salary is X. Similarly, I am calculating average holding period. So my holding period is X and holding period is year, that is X. And the weights is my amount, and to be specific, present value. So my discounted cash flow is W weight. And if I multiply both X into W, I do the product, that is summation XW, and I do this weights total, this summation W, So weighted average x bar or duration is given by summation xw divided by summation w. That is basically the product column divided by present value column, weights column. Now, but can you tell me, can you imagine what is this DCF will be? This DCF column, discount cash flow column, is present value column. And we are calculating present value of coupons and discounted YTM. When I use discounting rate, what will be my present value? My present value is nothing but market price of the bonds. Why market price of the bond? When the discounting rate is YTM, when discounting at YTM, discounting factor is YTM, the present value should be market price. That's how we would have calculated implicit rate, IRR rate YTM. So when I discount YTM, my present value should be market price. This is about duration, average, holding periods. One more shortcut formula is also there, but let's understand this. Institute does in one more method. They convert this weight into proportion. The DCF divided by total, DCF by total, you get on proportion column, P column, proportion. That they multiplied by year, you get the same answer in the column total. That is also you can present, but that will end up in one more extra column, so I'm avoiding it. Anyway, so you can write down this duration part. Okay, I'll go further next. So this is about duration. Hope you understood duration. Application problem. There is also something like bond immunization and all concept. We will use the duration part. We'll take up in the problem. Then you understand. Okay. Then I'll come to next concept, volatility. Okay. Now what is volatility? Means response, sensitivity, different ways. Between what? So if you compare value of the bond or market price of the bond is influenced by what variable? Is influenced by coupon, and last year you will have redemption price, and you are going to discount it. And what is a discounting rate? Discounting rate is YTM, right? If discounting rate is required rate, then you get value of the bond. When discounting rate is YTM, I get market price. Now, coupon, will it change? Now, coupon don't change in regular bonds. Coupon is a fixed. The redemption price, that also will not change. This also is fixed. Then only thing what is variable, changes with respect to market movements, is YTM. It fluctuates, varies, variable. So the only reason why the market price of the bond changes is because of YTM. So what connects between the two? Between the market price and YTM, and that is called as volatility. So if I represent in the graph as, let's say, in y-axis and x-axis, let's say YTM, in x-axis, let's say price, market price of the bond. And if you draw the graph, it will be downward graph, because it is inversely relation. It will be downward, but it will not be a straight line. Why it's not a straight line? Because I told you 2% upside, 2% downside, the moments are not equal. So it is not linear relationship, it is curvilinear relationship. So as the YTM increases, market price reduce, but not in a linear manner, but in a non-linear manner, in a curvilinear manner. It is the moment sensitivity. But how do you calculate the curvilinear relationship is not so easy. For which we have gone for volatility is actually a measure of linear relationship. So we can say volatility is a measure of linear relationship between the price, market price, and yield, YTM. So you draw linear relationship. That means you draw a straight line. I mean, I'm not sure whether I can draw. My hands are shivering. But please draw a straight line. Don't draw like this. Okay, don't think. Yeah. This line is what is volatility is all about. Measure of linear relationship. But why are we writing linear? Isn't that linear and non-linear different? Don't worry. If I draw line like this, you understand it is a curve. I mean, it's a non-linear. If I draw like this, it's a linear, big one. But if I write small one, suppose this one, does it look like linear or does it look like non-linear? When it's the movement is small, you don't really worry about whether linear or non-linear. So when the movement is small, both relationship coincide. You can see here from point A to point B, if I look at, the movement is small. The linear, non-linear is very close. But if I look at point A to point C, the linear is different, non-linear is different. The line curve, there is a gap. So we just say that when movement is small, both linear and non-linear gives approximately same answer. Gives approximate or approximate, you can say both linear and non-linear are approximate. And formula, duration is given by, volatility is given by duration divided by 1 plus YTM. Simple formula. Duration by 1 plus YTM. So if I tell you volatility is suppose 3, what does it mean? If YTM changes by 1%, the market price changes by 3%. The price and volatility, you see what connects between the bond and YTM. It's a measure of linear relationship between price and yield. So if yield changes by 1%, the market price likely to change by 3% approximately, not accurately, because this is measure of linear relationship. Is also called as first derivative, because if you treat like an equation differentiation, you may not know it, but it's also called as first derivative. If you treat in a differentiation, this volatility is also called as first derivative. So volatility is duration by 1 plus YTM. So higher the volatility, higher the sensitivity. If volatility is high, that means the bond moves faster. Because if volatility is 3, 1% change, 3% movement in the price. If volatility is 2, 1% change, 2% in the market price. So basically, higher volatility means higher movement, higher risk. Of course, related to interest rate. Okay, now, but this is only when the moment is small. But we want to remove that effect also. I don't want that small moment also. I want accurate answer. So I want to bridge this gap between linear and non-linear adjustments. If you want to bridge the gap, that is called as convexity. I just try to give you the context once more because I don't know. Some of you might be feeling slightly this is going out of the context. So let me try to bring it everything into the place. Start fresh. Valuation of bond. Present value of future cash flows. Coupons, redemption price, discounting rate, present value, value of the bond. If I discount it at YTM, my present value becomes market price. So the market price is same for everybody. That is what YTM is same for everybody from instrument point of view. And there is inverse relationship between the YTM and the price. YTM is the discounting rate, price is the present value. So inverse relationship. How to measure that relationship? If YTM changes by 1%, how much market price changes? That is what is volatility. The relationship between YTM, yield, and price, market price. Actually, the relationship is curve. But when I calculate volatility, it's actually a line, linear relationship. But interest rate movements are very small, so we really don't care. Approximately, line and curve are same when the movement is small. But I don't want to get that approximate answer. I want to be even more accurate answer. I want to bridge the gap between the curve and linear. Then I get concept called as convexity. Convexity. So it is a measure of, it's a second derivative. It is changing the linear relationship. It is second derivative. It is changing the change. So it is a measure of non-linear relationship. So we can say it is a second derivative. Second derivative in the function. Okay. So one formula looks like complicated, but let us write it. Convexity is price if YTM increase, then plus price is YTM decrease minus 2 times the market price divided by 2 times the market price into change in YTM. We say delta YTM. Delta means change. Change in YTM square. So price if YTM increase, price if YTM decrease, minus 2 times market price divided by 2 into market price into change in YTM square is convexity. And if you want to adjust the linear to non-linear, we call it as convexity adjustment. Convexity adjustment. That is, if you want to adjust the linear to non-linear, that is C into delta YTM. Delta means change. How much? 1% or 2% like that. change in Ytm square. Anyway, you write down later. We can look at its detail, but basically it is a measure of non-linear relationship that try to understand. If you remember differentiation, I don't know whether you know it. Dy by dx is first derivative. D square y by dx square. That's called a second derivative. So convexity is the second derivative. Anyway, we can do faster. We can use the columnar format also. Let me see that if I can give you columnar format faster. Okay. So if remember what column we used to do in the duration calculation, we used to have year, that I used to call it as X column, then cash flow, discounting factor at YTM, then we used to have discounted cash flow, that I used to do as W, and then we used to do X into W. Remember, I discussed for duration. Now, what do you do for convexity? You have one extra column, that is, you do X into W. Instead of X into W, you have one more column. You make it as X into W you do, but you multiply it by X plus 1. That is, if here is 1, you multiply it by 2, like that. That column total you do. Using that also we can get the convexity. So I'll just tell you from this column, how can you get? Convexity is C is summation XW into X plus 1. That's what this column total means. That column only will give you the total. Divide by summation W, that you do anyway, into 1 plus YTM whole square into 1 by 2. So this will give you the convexity formula if you want to do using the columnar method. So that this big calculations you need not do it. Anyway, convexity in the exam, they've asked about only once in last many years. So I don't say it's very important, but just keep it in mind. It's a mechanical calculation. So what and all we have discussed so far? Value of the bond, that is intrinsic value of the bond, YTM calculation, duration, volatility, convexity. Couple of more concepts are there. I would like to cover everything at one shot. Then I can take up problems, whichever is relevant one. I can take one after another, relevant from exam point of view. So when I take up the problem, these things will be repetition. I understand at the beginning, these things will feel like too heavy for you. So it would be beneficial if problem is there. That's good. But let's follow the process. Let me give you the overview. Then we take down one by one. Okay. So then I'll go for the next concept. Hope you have taken down this one. Okay. Okay. So next concept we have is yield curve. Okay, yield curve. What is yield curve? You would have seen in fixed deposits when you deposit. If you deposit for 6 months, you get, let's say, 4%. If you deposit for 12 months, you get 6%. You deposit for 1 year, you get 6.5%. If you deposit for more than 3 years, you get 7% flat. Example, right? As everything is percentage per annum basis. As the maturity increase, your rate of return also increase. That's called as yield curve. So yield curve, on one side you express maturity, on other side you express yield, YTM you can see. Now, and the curve will look like this. As the maturity period increases, you also start getting higher rate. For example, if it is 1 year, let's say you get 6%. If you deposit for 2 year, let's say you get 7%. If you deposit for 3 year and above, let's say you get 8%. But one thing you observe, first 1 year you deposit, you get 7%. If you deposit for 2 years, you get 1 year deposit, you get 6%. 2 year you deposit, you get 7%. Now you please tell me, for extra 1 year, am I getting only 1% extra? What do you think? If I deposit for 1 year, I get 6%. If I deposit for 2 years, I get 7%. Does it mean for extra 1 year, I get only 1% extra? No. Where we are going wrong? This is 6% per annum. This is 7% per annum. So it's actually, this is 6% for 1 year. For 2 years, I am getting 14%. So my incremental return is 8%. Are you understanding? When I deposit for 1 year, I get 6%. When I deposit for 2 years, I get 7%. For both the years, I get 7%. Actually, totally, I get 14%. So what is my incremental return? Incremental return for increasing the period is 8%. Extra return for second year, indirectly, I am getting 8%. Right? That is called as forward rates. So this 7% per annum is called as YTM for second year, because it is applicable. YTM you get 7% for first year as well as second year, whereas 8% you get only for second year, and that is called as forward rate for second year. So what is YTM? YTM is yield for certain number of years, whereas forward rate is the rate of interest applicable for a particular year on an incremental basis. So YTM is the yield for certain number of years, whereas forward rate is the return. FR, forward rate, not your financial reporting. FR, forward rate, is the return for a particular year. So yield curve, as the maturity increase, your average yield increases. You can say yield curve is like an average. Whereas forward rate is the rate applicable for a particular year on an incremental basis. On a incremental basis. Okay, so hope you got this. Let me give formula now. So if I want to go from 0 to, let's say, third year, if I want to do using YTM, how do I calculate? Present value directly using third year. I mean year 0 to year 3 if I want to calculate. I'll do just 1 plus multiplication model, okay? 1 plus YTM of year 3 whole cube. That is one straight method. That is using yield, using YTM. But if I want to go using forward rates, what do I do? I'll do like this 1 plus forward rate of year 1. I moved to year 1. 1 plus forward rate of year 2. I moved to year 2. 1 plus forward rate of year 3. I moved to year 3. So 1 year at a time. Every year forward rate can change. 1 year at a time is forward rate. For all the 3 years put together is YTM of year 3. So in general we can write like this. 1 plus forward rate of year 1 is equal to 1 plus YTM of year 1. Why am I writing every time 1 plus 1 plus? We follow multiplicative model. Every time I move from year 1 to year 2, I don't do year 1 plus year 2. Multiplicative model. Year 1 plus R1, then 1 plus R2. I do 1 year at a time. So only first year forward rate is 1 year YTM. Or in other words, you can say forward rate of year 1 is YTM of year 1. If I increase by 1 more year, 1 plus forward rate of first year into 1 plus forward rate of second year. So 1 year, I move to second year. So I can use 1 plus YTM of second year whole square. Second year YTM based on first year and second year. You can say average rate based on first and second. Third year means 1 plus FR1, 1 plus FR2 and 1 plus FR3, 3 year. So together I can write 1 plus YTM of year 3 whole cube. If I write 4 years, 1 plus FR1 first year, 1 plus FR2 second year, 1 plus FR3 third year, 1 plus FR4 fourth year, then what I can write? 4 years are there. So 4 year YTM I can directly write 1 plus YTM of year 4 whole to the power of 4. So this is what is the yield curve, YTM and the forward rates is all about. You can make a note of this. Okay. Next concept. Convertible bonds. Bonds are fixed income securities, but that can be converted into shares. Typically, it's required from a business point of view, some practically, because as an investor, initially company makes losses. So I don't want to take that loss. I want a fixed interest. I want to be bond holder. But once company starts making money, I want to be equity shareholders because I can get a share of profits. Because bond means fixed income, but equity share means I can get more in the money. That's why we go with this concept of convertible bonds. So when they give you this convertible bonds, certain measures they'll ask you to calculate. Like you have conversion value or equity value. Conversion value means if you convert the bonds into equity share today, what will be the value? That is, you say whatever is the market price of equity share, I'll say MPS into conversion ratio. For example, if bond price face value is thousands, and they'll tell you you get the ratio of 1 is to 20, that is, or 20 is to 1. For every one bond you have, you get 20 equity shares. Conversion ratio 20 shares for every one bond you have, convertible, 20 is to 1. And let's say market price of equity share is, let's say, 12 rupees. So then how do you calculate? If you convert the value, it is too less, no? 20 to 12. Okay, let's say 45 rupees. Market price, let's say 45 rupees. So 45 rupees into 20, 900 rupees. That is conversion value. So what is conversion value? If the bonds are converted into the shares today, that's called as conversion value. Market price into conversion ratio. Okay. Now, if market price of bond, convertible bond, let's say if it happens to be 920 rupees in this case. Now, what is conversion value? 45 into 20, you get 45 market price, 20 is the ratio, it is 900. So, if you remain in bond, market value of the bond is 920. If you convert into shares, it becomes 900. Do you think you will convert or you don't convert? Obviously, you don't, right? It's better you be in the bond because value is high, then you convert it into shares where it becomes less, 900 rupees. Okay, now how much extra is there to be in the bond? That's called as conversion premium. Conversion premium per bond. That is, whatever market price of convertible bond, market price of convertible bond minus market price of, minus conversion value. If you convert, what will be the value? Minus conversion value. Like in this example, market price of convertible bond is 920 minus conversion value. It is, if you convert, 900. So what is the extra amount that you're enjoying by being in bonds? That is 20 rupees. That's called as conversion premium per bond. You can divide by conversion ratio, you get per share, or you can divide by the market price of the bond. You can express in percentage, divide by conversion value, different form. But premium means extra amount that you are having for being in bonds. Conversion premium per bond. Then one more we have is called as parity price. Okay, now what is parity price? Now please tell me, at this point of time, is it better to convert into shares or be in the bond? We just now discussed, if you're in the bond, value is 920. But if you make it into shares, the value is 900. it's better you be in the bond. Now, if market price 45, if it becomes, let's say, 47 rupees, if it becomes 47 rupees, then what will you do? Is it better to convert into shares? 47 into 20 shares, you get 940, right? 47 into 20. You get 940, which is more than 920. So you have a better value by going into the equity shares. So at 45, it's not good. But if the market price becomes 47, it is good. So when will you change the price? Beyond which it's better to shift. Up to that, don't shift. That's called as parity price. So the formula is market price of convertible bond, market price of convertible bond divided by conversion ratio. So in this example, convertible bond is 920 divided by ratio is 20. So you'll get 46 rupees. So if the market price of the share, parity price, 46 equal, indifferent. If it goes beyond 46, then converting it's better. Below 46, converting it not better. That is parity price. Then one last one is called as downsize risk. This is given by the market price of convertible bond minus straight value of the bond divided by straight value into 100. What is the downside risk? In the sense, you are having convertible bonds. If conversion option not there, do you think the value will become zero? In the convertible bonds, if conversion option is not there, the company losing or company not making profits, you are not likely to convert. If conversion value not there, if you're not getting converted, still some value is there in the bond because you're having the right to receive coupon, you're having the right to receive redemption price on maturity. That is called as straight value. Or I can also say non-convertible bonds. In convertible bonds, there will be some portion, some value of non-convertible bonds. That is called as straight value bond. Suppose in this case, market price of convertible bond is 920, non-convertible bond is, let's say, 900, or let's say 850 rupees. So even if the conversion is not there, still it's worth 850. So maximum loss is 920 minus 850, 70 rupees. That's called downsize. Even if conversion is not there, still you have some value. It's called a straight value. And divided by to express in percentage, some people divide by straight value, some people divide by market price of convertible bond. That difference of opinion exists. You can use any one of them in examination conditions. Okay, so this is the important terms associated with convertible bonds. Okay, hope you have taken down this approximate formula. Anyway, material should have all these formulas. Okay, so far what we discussed: value of the bond, YTM, duration, volatility, convexity, or convertible bonds, even YTM, then forward rate. All these are discussed from investor point of view. We only have one variety of problem which is discussed from issuer point of view, that is the problem on replacement of bond. Replacement of bonds. Do you remember we had in capital budgeting in your previous life, long ago? Machinery should be replaced or not. Replacement problem on machinery. You have an existing machinery, you sell the existing machinery, you replace the existing machinery, right? We used to compute NPV. If NPV of that is happen to be positive incremental NPV, then we say replace. A very similar situation. You are having an existing bond and you are trying to replace with new bonds. Existing bond you redeem and replace with new bond. So you're having two choices. One, existing bond you continue, or one more option is you redeem existing bond and issue new bond. So one option, you continue the existing bond, and second option, you redeem the existing, issue the new bond. What is the difference? Incremental benefit. Differential, incremental benefit, incremental benefit. Why is it required? Why is that situation arises? Because of the practical scenario, market factors. What is happening now? Suppose you have issued 15 years back, 20-year maturity. 15 years back, 20-year maturity, and 15 years back, what is the rate of interest prevailing then? Think from issuer point of view, maybe even 12%. 15 years over, 5 years pending. Still, you have to pay 12% only because committed, it is fixed. But now, if you look at outside, everybody is paying less interest because now in the market, interest rates have come down, but you can't do anything. You are having stomach burning. Everybody is paying less interest. I have issued this bond long time back. It's like mobile phone, no? You have purchased the mobile phone long time back, Nokia 1100. If you're using still today, you will not be using it. If it's using still today, what do you do? Everybody else using smartphone, but I purchased long time back. So what do you do? This existing one, let me take it off, and new one I will buy. That's what here also we are doing. Existing bond, you pay it off, redeem it. Old bond, the new bonds, let us issue. We can save interest cost every year for 5 years. Next 5 years remaining. So those 5 years, not only you get benefit, it will have some cost also. And we are going to do cost benefit analysis and we'll compute NPV. How are we going to calculate that? Observe. I will divide the cash flows into three parts. Initial cash flow, interim cash flow, and terminal cash flow. I'm using this even in my capital budgeting also. Very easy to do it logical manner. Initially, what happens today, interim, over a period of time, what happens, and terminally, what happens. Initial cash flow, if you continue the existing bond, then there is nothing. No cash flow today happening. You already issued back. But if you redeem the existing one, then what you're going to do? You will have a redemption value outflow, right? Outflow, redemption of old bonds, existing bonds. And on this redemption, sometimes you have to pay premium. It's called as call premium. Why? Because it was having 20 years maturity. You're redeeming it earlier, like a repayment of your housing loan earlier, pre-closure. The holder will lose money. They charge you, you're redeeming earlier, pay me premium. It's called as call premium. And this is an expense allowed for tax purposes. So I will do into 1 minus T. So redemption of existing bond is outflow. But new bonds will come in. So I will say issue of new bonds. That will come in. But when new bond comes in, it will not come free. You will have some issue expenses, underwriting charges, stamp duty charges, registrar's filing fees. So you will have issue expenses, flotation cost, issue expenses. But I don't do 1 minus T now itself because this issue expenses will not be allowed immediately. It is spread across over a period of time. And what about the old expenses? When the old bonds, the existing bond issued 20 years back, it would have been spread across 20 years. 15 years only over, remaining 5 years still pending. That will be allowed for tax purpose immediately. So, remaining unamortized issue expenses, unamortized old bonds, okay, unamortized issue expenses multiplied by T. So these things are part of initial cash flow. Nothing in existing bond. These things you put together, that is in replacing with new bond, then you calculate the incremental. Okay. Every year what do you get? Every year you should focus on two types of cash flows. Existing bond, you pay existing interest rates. You pay existing interest rates, existing rate. If you redeem with the old bond, then you will pay with the new interest rate, which is lower interest rate. And both of them make it after tax. So if it is after tax, I multiplied by 1 minus T. Then you find out the differential. And more importantly, this comes. Had you continue with the existing bond, this unamortized issue expenses still would continue. Had you continue with the old bond, so you will have this amortization expenses. And if you continue with the new bond, then it will be new expense, amortization of issue expense. This is old, amortization of issue expense. This is old. Now you will have amortization of issue expense, which is new. And issue expense is not a cash flow. It happened already. But why are we taking it now? It's tax impact. So I should multiply it by T, like a depreciation. In both cases, you multiply it by T. That also you find out the difference. Now, remember, this initial cash flow happens today. But interim cash flow happens every year. So if every year happens, this incremental cash flow, if I bring it into present value, what should I do? I have to multiply it by annuity factor. When I multiply by annuity factor, I get the present value. And terminal cash flow, I get the redemption price, redeemable value under existing bond, redeemable value under new bond, difference multiplied by discounting factor. This redemption value, if any difference is there, you multiply it by discounting factor. It happens on maturity. It happens only once. So this initial will be outflow usually. Interim will be inflow usually. Terminal may be anything. NPV you calculate. If NPV is positive, we say redeem the bond. If NPV is negative, then we say do not redeem the bond. Very important concept where most students go wrong is on this amortization expenses. That is where institute, that's where many people go wrong. And institute does not represent this in a columnar manner. So that's why if you follow this columnar manner, the problem becomes much easier, faster, and also simpler to present in exams. So this is one variety, only variety from issuer point of view. Okay. So this is all about the bond valuation overview. Now quickly I'll take you through a little bit of more theory concepts so that this initial discussion, this summary discussion, we can conclude. Okay. Okay. So bond valuation is what we have discussed initially. YTM, yield to maturity, is the rate, discounting rate at which present value becomes market price. Duration, average holding period. Volatility, connection, relationship between YTM and market price. Convertible bonds, various terminology, when to convert, conversion value, conversion ratio, parity price, downsize risk, conversion premium. Yield curve. Yield is the average rate applicable for certain number of years. Forward rate is the rate applicable for a particular year. And then bond replacement decision. That's only problem from issuer point of view. All other concept is from investor point of view. Topic wise allocation, it is there in the material. You can go through it. Like to discuss some theory points. Just 1 second. Like we have types of bonds and all. Just give me 1 minute. Okay, so what is a bond? It's an instrument representing debt, like a loan taken, but main feature is it is tradable instrument, trading in the market. It's a fixed income security. We will have a face value. On face value only we apply coupon rate, and coupon is treated like a cash flow, not like an income. And frequency of repayment can be annually, quarterly, half yearly, and so on. And it will have a maturity period, just like a loan. Types of bonds. This one I would like to tell you now. Most of the bonds what we discussed so far is a fixed rate bonds, where the coupon rate is a fixed at the beginning and that will not change. Interest rate and redemption price is fixed. Whereas we also have floating rate bonds, where interest can fluctuate, the coupon rate can fluctuate with respect to the market rate. That is called as floating rate bonds. So every year, next coupon, how much you are going to do, it's fixed today. And next year. So every year, the rate of interest changes in line with the market. That is floating rate bonds. Then we have types of bonds. 4 major types are there. Regular bonds, what we discussed so far. Regularly, you pay coupon, and on maturity, you pay redemption price. That is regular bond. We have annuity bonds. What is annuity bond? Like installment in your loan. You don't pay repayment only at the end. You pay annuity value. Every year, you pay principal as well as interest. Equal amount. Like installment. Like installment you repay. Like that, bonds also will be there. Annuity bonds. Like installments, which comprises of interest as well as principal. Perpetuity, where no repayment unless company winds up, meaning only coupon is paid, redemption price is not paid at all, it is ignored. So it's only present value of interest, perpetuity, and formula wise present value is given by annuity or whatever the cash flow, interest, coupon divided by interest. That's all. No 1 plus R circus. Just cash flow by rate of interest. You get perpetuity value. We have zero coupon bonds. Zero coupon, as the name suggests, also variety deep discount, where there is no coupon. That is only on maturity you will have. No year 1, year 2, year 3 coupon into annuity factor, that will not be there. Only your redemption price. So redemption price, you multiply it by the discounting factor, you get the present value of zero coupon bonds. Valuation of bond, which is discussed, initial cash flow, market price, interim cash flow coupon, terminal cash flow redemption price. When I calculate present value using present value of coupon and present value of redemption price using required rate of return, I get value of the bond. But if I do the same thing, coupon and the redemption price using YTM as discounting rate, then what I get is market price of the bond. If nothing is specified in the problem, we'll assume value equal to price and we'll assume required rate is equal to YTM if nothing else is specified in the problem. So this is your complete picture of bond valuation. Okay, so we'll stop at this point today. Remaining portions we will take it from tomorrow onwards, whatever the pending part. So step at this point. We'll see you tomorrow at the same time, 6:15. Okay, 6:15. Till then, take care. Have a nice day. Bye bye.